Good morning. It's Dan Kerr's DK Analytics. Thanks a lot for tuning in. It is November 15th, 2019, on a cloudy and relatively cool Southwest Florida morning. This is quite the change from prior months, during which from August through to, in essence, early November, we had unseasonably hot and dry weather. In fact, to give you a sense of how hot it has been and through about a week or so ago, the thermostat, which I have on a shady wall of the house regularly until about a week ago, registered into the low to mid 90s. At around 2 or so in the afternoon. But hopefully we're into a rainier and cooler period. Actually, it should turn drier, but we didn't get the water we needed. The spigots didn't open, so we're likely going to have some kind of water issues here before the next rainy season comes in June. I wondered about what to call this video, and I came across with two simple words, and they are what gives. So that's the topic, what gives. Before I delve into it, let me give you some valuation metrics. All of these are as of yesterday's closing, save for the trade-weighted US dollar, which is a Fed statistic that lags about a week, I think. The trade-weighted US dollar stood at 92.59. The US 10-year Treasury yield was at 1.82%. The S&P 500 keeps on chalking up one record close after the other. It closed yesterday at a record 3098, and it's probably going to go higher, or is going higher today. Oil closed yesterday at $56.88 per blue barrel. Gold at $1,471. When I say dollars, I reference US dollars. And silver closed at $16.99. That is $16.99 per troy ounce. The dollar isn't losing more ground. It was, or started to, despite a massive return to money printing by the Fed, which I think is odd. But I'll get into that more later. In contrast, however, the 10-year Treasury has lost ground from the sub 1.5% yield levels about 9 weeks ago, and given the recent 1.8 to 1.9% levels. And this has the weaker Treasury bond, the rising yield, has been, as news is rolled out, that we're getting ever more deeply into debt and also some inflationary rumblings that I'll get into. But speaking of getting into more debt, at the federal level, the national level in the United States, the debt increased by a whopping $1.3 trillion in fiscal 2019, which supposedly isn't a recessionary year. Wasn't. It ends at the end of September. I beg to differ, but it's going to get worse, and so will the deficits. That's the point. In fact, the total disclosed federal debt, and I say disclosed carefully or purposefully, exceeded $23 trillion, well in excess of GDP, about 104% of GDP. The gathering correction in the Treasury bond is perhaps a belated sign that investors are sniffing sustained signs of inflation stemming from this long financial repression, revisiting QE, dropping rates. In other words, from the Fed's renewed balance sheet bloat, most specifically, to progressively stickier and higher producer and consumer prices. Stocks, meanwhile, continue to set one record after the other on the back of increasingly stout Fed put a Powell put, which is quite the 180 in less than 6 months, as was initiated when the stock market really fell out of bed in December of last year. In the interim, gold and silver continue to languish in US dollar terms during a time of increasingly clear and heightened fiat currency debasement. Unsustainable debt growth virtually everywhere you look, domestically and globally. The biggest drop in US productivity since Q4 15. It fell by an annualized rate of 0.3% in the third quarter of this year, while unit labor costs grew at a 3.6% annualized rate, also in the third quarter, the fastest pace in more than 5 years. If that wasn't unsettling enough, we face domestic political risks that are rising. Just look at the circus in DC, and rising geopolitical uncertainty, be it in Asia or in the Middle East or in Latin America. In short, what gives? Let's briefly glance at the Fed's renewed balance sheet expansion campaign. Its 180, or about face, if you will, is as obvious as it is stunning in its magnitude. A magnitude that puts prior peak Fed monetary base expansion per month of up to $85 billion to shame, quite frankly. I'm referring to the $277 billion increase in total Fed assets, which are also called monetary base assets or its balance sheets, same thing. In any case, a $277 billion increase in the Fed's balance sheet over a 2-month period, specifically from $3.762 trillion in early September to $4.039 trillion by early November. That's a whopping $138.5 billion expansion per month if one divided the figure by 2, which is 63% higher than the highest rate of QE of $85 billion per month. Yet there is no QE, says the Fed. At this rate of non-QE, by the way, the Fed's balance sheet would exceed its old high of $4.5 trillion in under 4 months. Take a look as I try to bring up this chart. Here we go. This down here, that's just in early September, that's a 3.762 trillion balance sheet. And whoop, we've come all the way up here within 2 months, okay, within 2 months, or to 4.039 trillion, which again is 277 billion. And if we sustain this for less than 4 months, that is this, we'd be back up here at the previous balance sheet high of the Fed before it went into QT. Pretty powerful statement in terms of monetary debasement prior to the crap hitting the fan in a big way. Obviously, one needs to ask, or people are asking, what has the Fed done with the money that it has printed out of thin air? Where has it purchased? What assets has it purchased? Well, you probably guessed it. In the ultra short term refinancing market, the repo market, where the Fed's balance sheet went from zero holdings a few months ago to 215 billion by the end of October and climbing still. And also the Fed has been purchasing treasury bills, which mature in less than a year. an arena or an asset which the Fed has committed to purchasing $60 billion of per month through Q2 of next year. Now, what have we heard of such deadlines before? In other words, they'll likely keep purchasing way beyond Q2 of next year and expand their purchases of various assets. We heard about it with the repo market, where their intervention was supposed to end by, I believe, mid-October and is still ongoing. Why did the Fed do this? Non-QE. Well, to get short-term rates to heal with the Fed funds rate diktat. In other words, they want to determine rates, short-term rates, and to the degree they can, long-term rates, not the private sector, the free market. This helps us move, that is, the Fed's intervention helps us move away from what was becoming an inverted yield curve, to the degree that the Fed can overpower with these massive purchases the private sector at the repo level and get it lined back up in sync with the Fed funds rate. Then we move away from an inverted yield curve, which is a no-no, an inverted yield curve for the pampered crybabies on Wall Street, concerned about both their racy balance sheets, liquidity bona fides, as well as their cheap short-term funding addiction. More importantly, to keep one of the underpinnings of the short-term financing from unraveling, specifically a multi-trillion-dollar private sector market based on a functioning repo or repurchase agreement, a market which features overnight to 2-week maturities financing. When the repo market began to seize up 2 months or so ago, and repo rates reached 10% prior to increasingly pronounced Fed intervention, banks became increasingly loath to risk their capital by lending to the repo market. The reason for this? Spreading concerns about repo borrowers' liquidity and solvency, but especially liquidity. Borrowers whose short-term source of funds are repos makes them highly susceptible to rate increases there. Makes sense. Plus, these very borrowers typically invest the same repo funds in longer term or even long-term bets, and to add even more risk, they do it in a highly leveraged manner. Who might these firms be? Well, it's the moral hazard Wall Street crowd with monikers such as hedge funds, private equity outfits, and REITs. Are you connecting the Wall Street bailout dots that are being rationalized away by stating that the economy can ill afford a liquidity squeeze, or failing Wall Street institutions? You know what that can bring with it, the daisy chain, right? Which would, by extension, bring down our whole financial system. Once again, sound familiar? It should. It's another shade of 2008, but this time the intervention is before the debacle. And remember, if you would, who owns the Fed? The Wall Street banks, of course. What a racket. The Fed response to the repo issue at the end of the day is more de facto bailouts for Wall Street cronies making unfathomable amounts of money that increasingly distrust each other's racy balance sheets. Balance sheets featuring huge asset liability duration mismatches. In other words, borrowing short and lending long. In this case, with immense derivatives-based leverage layered on top. The inescapable takeaway revisited: Wall Street's moral hazard allocation bets are both Fed-financed and taxpayer underwritten. With literally trillions of dollars in bank exposure to the repo market, which they fund, 2.2 trillion was recently stated as the size of this by the Securities Industry and Financial Markets Association. With this kind of exposure, one could say that banking solvency would be imperiled if a sudden, drastic, and lingering spike in repo rates made it impossible for repo borrowers to refinance their short-term funding, much less repay it within up to 14 days. This de facto repo asset liability mismatch exposure that could imperil banks is worsened by the lacking incentives to save thanks to zero interest rate policies. That is, depositors get no return on their deposits, certainly no real returns. Those same depositors supply some 55 to 60% of a typical big bank's capital, its balance sheet. Should depositors smell trouble, they may decide to take their money and run, which would quickly freeze up the system, as banks only keep a low single-digit percentage of deposits in cash. The rest is obviously put to work. More asset/liability duration mismatch stuff. Clearly, a bank run, which is what is really feared, must be avoided at all costs. Of course, not for depositors' sake, who get nothing but currency debasement in a best-case scenario in return for lending a bank their savings, but for the sake of oligarchs running the backstopped moral hazard show. In a worst-case scenario, there are statutes on the books in many Western nations, very much including the United States, which allow regulators to bail in depositors as necessary in order to prevent a financial meltdown. Regulators can convert depositors' deposits to bank equity stakes to keep banks from going bankrupt as necessary. Just imagine what those equity stakes would be worth. Moreover, consider the nerve, the chutzpah of regulators purportedly having taken oaths to uphold the Constitution, including its stout citizen-based property protection provisions, deciding, those regulators, that grandma really didn't want a sound deposit account at her local or national bank, but that she really wanted, after suffering yield deprivation for over a decade, was to convert her savings into bank stub equity. I mean, good grief. You can't make this bold-faced crony lawlessness stuff up. Who needs to watch a soap opera? Sad but true. As such, is it any wonder that the gap between the 1% and the rest of us keeps widening relentlessly to an unheard of magnitude? I think we'd both say no. What is surprising, in fact very surprising, is that the father of this grotesque crony inequity, the Fed and other central banks, even reports on the widening wealth and income gaps with graphic detail on, I believe, a quarterly basis. I guess they, the Fed officials, are so convinced that too many Americans could care less or have given up caring that they have no shame in publishing what they have wrought. For those with an interest in examining this stunning bifurcation more closely, in all of its societally destructive ugliness, let me provide you with a link in the descriptive portion of this video. But before I do, a small bit of report flavor, Fed's report on spreading gaps in wealth and income, in terms of what has happened since financial repression really went off the deep end a bit over 10 years ago. The wealth of the top 1% has soared by a whopping $18 trillion in the US to $34 trillion. Meanwhile, the wealth of the bottom half of American households grew by only $1.4 trillion to $2 trillion over the same decade. That $2 trillion, a 6% fraction of the top 1%'s $34 trillion of wealth. This is societal inequity dynamite, which could result in much harder treatment than taxation of capital going forward. Never mind that legitimate Main Street capital earned the old-fashioned way over time, typically brick by brick, year after year, with real products and services, not financial engineering underwritten by the Fed and taxpayers. Main Street capital, that Main Street capital, will also get hauled onto the carpet after having already been put through or thoroughly beat up by regulatory compliance insanity and or litigation excesses for decades, which together amount to nothing other than de facto redistributionism from legitimate makers to leeches, including crony capitalists, ambulance-chasing lawyers, bureaucrats, and takers in an overall sense. In the interim, between now and then, even more crony bailouts, fathered by central bank cabals, now with the Fed very much on board, are beginning all over again, just as an over-leveraged, over-regulated, terribly misallocated Main Street maker eviscerating economy is increasingly succumbing to old age and a toxic public policy stew, which the powers that be will not relinquish until they absolutely have to. That is, until the markets force it, or until economics once again trumps politics, at which point we'll see financially engineered EPS in the United States get walloped, which even a financial repression-goosed stock market won't be able to ignore. The upcoming EPS compression will, as I've often repeated, be even more pronounced and longer lasting than usual, given the deep, deep crap that we are in globally in virtually all of the just mentioned realms, starting off with over $250 trillion in global debt, which is roughly 3 times global output of $86 trillion, or some 85 trillion higher than 10 years ago, which is the rough equivalent of 1 year GDP. That's how much debt we've added in just 10 years. One global GDP print. Going forward, we should see unparalleled expansion of global central bank balance sheets, right? And why should we see this? Because the outsized growth in debt that we've seen, that we've witnessed, is ultimately a reflection of faltering productivity growth, which is going to get even worse. But the unparalleled expansion of global central bank balance sheets will be due to A, progressively larger public sector deficits associated with aging societies and our huge pension funding gaps, financial engineering based, due to what? Off the charts money printing, financial engineering. And B, due to simultaneously trying to prevent the Fed and other central banks price discovery in the bond market. So this 1-2 punch of addressing larger public sector deficits, greater pension underfunding, which governments will only be able to fund via printed money, and at the same time preventing price discovery, that is, a bond market and the bond vigilantes, which would otherwise send interest rates much higher to reflect increasing monetary inflation and insolvency risks. Why does price discovery have to be avoided in the bond market, most especially, for as long as possible? Well, it's simple. Because an over-leveraged economy cannot withstand higher interest rates. That's why. Yet, without higher interest rates, and this is the catch-22, you won't have the savings to finance investment, and thus productivity advancement that would, if it were on offer, require less external financing or debt. Call it a vicious cycle or circle. Bottom line, unprecedented fiat currency debasement is in the cards, which a public sector deficit widening recession will only exacerbate. In light of this hopefully more right than wrong global assessment, what gives? Specifically, why are gold and silver prices not pricing all this ugliness in? Especially given continued stout global demand for gold, even the Bundesbank has allegedly started to buy, and given that demand for silver continues to exceed mine-based extraction by a wide margin, as in by 21% in 2018, according to the Silver Institute. Once again, what gives? Said differently, why are silver and gold prices, in dollar terms, not exploding to reflect not only what is down the road, but the rapidly ramping up fiat currency destruction that the Fed has just returned to, which the ECB will ape sooner than later, and which the Bank of Japan, BOJ, has never left. And by the way, all these central banks want to keep their currencies from becoming too strong, which will only add another layer or dimension to their money printing efforts. Why then are precious metals not only not exploding, but correcting, with silver down roughly 13% from an early September high, recent high, and gold having corrected by over 5% since early September? This is all the more true given the small relative size of both precious metals markets. In other words, all these worrisome signs should have them go up, which is amplified by the fact that they're scarce. In terms of extraction, gold at about $160 billion per annum, and silver at about $15 billion per annum based upon current dollar prices of the metals. That's a small amount of new supply. In contrast, global debt grows in the trillions of dollars per year, substantially outstripping global GDP growth and casting a bigger and bigger shadow over much smaller GDP, a third of the size of the debt, and future growth prospects, while simultaneously increasing the pressure to print even more money to facilitate even higher debt at the lowest interest rates possible until it no longer works. In terms of accessible above ground holdings, let me drill it down a little bit here. There are about 6.2 billion troy ounces of gold, or about $9.7 trillion worth currently at current dollar price gold. As regards silver, when adding the melt value of very loosely estimated jewelry and silverware produced since 3000 BC to recent silver bullion stocks, I go into this in a lot of detail in my silver post, by the way. If one adds the estimated jewelry and silverware produced over the ages to recent silver stocks, then one gets a very conservative, in this case a high, 16 billion troy ounces of reclaimable silver number, or about $272 billion worth at the current silver price. If we strip out my very loosely assumed jewelry and silverware allocated silver, which I guessed made up 25% of silver demand through the ages, much like over the past decade, then the accessible silver is in the neighborhood of a much lower 1 billion to 2 billion troy ounces, less than gold's 6.2 billion troy ounces of above ground easily reclaimable silver, or in dollar terms, a skinny 17 to 34 billion dollars worth at $17 quote per troy ounce. That 1 to 2 billion troy ounce accessible silver tally, by the way, is what silver bugs widely assume as the best guess. But whether the current related dollar amount of readily accessible silver is 34 billion or 272 billion, obviously jumping silver prices will lead to lots of jewelry and silver melt, which is why I tend to include it. Whether it's 34 billion or 270 billion, it's frankly not as important as it sounds. Why? Because when looking at precious metals, we're looking at tiny assets in dollar terms, precious, rare, when compared to global investable assets which have been printed into existence, thought to exceed $250 trillion. Global investable assets have been quoted as exceeding $250 trillion by a couple reliable sources, and most of those assets are invested in bonds, about 60%, and stocks, about 30%. So, once again, please forgive me for repeating what gives. Why aren't dollar-based silver and gold prices fulfilling their canaries in the coal mine function by rocketing higher, given what's going on and given their scarcity in both absolute and relative to paper asset terms, to investable asset terms? I say this despite portfolio managers' reluctance to hold physical metals for their clients simply because portfolio managers can't earn anything on physical silver and gold stored in a vault, as I've said previously. And I also say this despite decades of Keynesian indoctrination, which has mistakenly led most people to believe, erroneously so, that precious metals are nothing more than barbarous relics, which is actually not what Keynes said. Perhaps as we consider this and look for reason, we should consider KISS, or keep it simple and straightforward. In other words, perhaps it is purely because, as Keynes famously said, I hate to keep referring to him, especially given what his legacy has done, but Keynes famously said, markets can stay irrational longer than you can stay solvent. Maybe that's why silver and gold remain in the dungeon in terms of prices, dollar prices. Or is it because futures contracts on the COMEX the other week saw over 950 million troy ounces of silver being sold, which is well in excess of annual silver extraction last year of 856 million troy ounces, according to the Silver Institute. If we lend credence to the COMEX story and to similar stories repeated over time at the COMEX and other exchanges, is it any wonder that silver is under pressure despite the headlines we have? The same is true for gold, by the way, where paper trading, daily paper trading volume exceeds annual extraction of the yellow metal in dollar terms. At the end of the day, perhaps what is most surprising of all, and arguably silver price bullish, is that the price of silver did not correct more than to the mid $16 range in a world where derivative tails continued to wag underlying asset dollars. And usually in a totally naked, that is unbacked by the underlying asset terms. Maybe, Mr. Keynes, that dog will soon return to wagging that tail after all, and perhaps a failure to deliver physical precious metals will finally result in physical precious metals price liberation, which would simultaneously kill the paper casino prices of gold and silver because the contracts can't deliver when push comes to shove, when it counts in terms of volume, anything other but the very fiat currency that precious metals investors want to diversify away from. That is, all the clauses allow exchanges to provide investors or would-be investors in these metals with dollars if they are metal short. Right, that's the fine print. But you're trying to get away from dollars. And once enough people realize that they're actually holding dollars and not metals, precious metals, well, then goodbye paper casino. I call it a 1-2 punch in the making. It's purely a question of when, I dare say, not if. In closing, I hope you found my thoughts of interest. Over and out on November 15th, 2019. I'm sorry. This is Dan Kurz of DK Analytics, enjoying a cooler and rainy day. Bye-bye.